Welcome to this explainer. Okay, today we're looking at something that honestly masquerades as a super dry accounting rule, but is actually a fascinating, almost philosophical debate about how businesses define their very reality. We're talking about capital maintenance and the battle between the financial and the physical.
Section 1, The Profit Dilemma, Measuring Reality. Okay, let's dive right into this. At the heart of literally every single business operation, there's this central narrative tension, a real dilemma about how we measure reality. We have to start by asking ourselves, what actually counts as true profit? Is it simply having more dollars in the bank at the end of the year, or is it the ability to actually produce more stuff? This isn't just an exercise in semantics either. It fundamentally changes how a business measures its success, its growth, and honestly, its ultimate survival.
Moving to Section 2, Defining Your Capital, Protecting the Baseline. So before we can even measure success, we got to define the baseline. What are we actually trying to protect here? Meet our first contender, financial capital maintenance. This is the traditional, incredibly common view. The ultimate goal here is just protecting the invested money, or the purchasing power of that money. It asks a pretty simple question. Did the monetary value of the owner's equity go up? Basically, if I put in $100, do I have more than $100 now? But then we have this radically different second worldview, physical capital maintenance. This philosophy, it doesn't care nearly as much about the raw dollar amount. It focuses entirely on protecting operating capacity, or output. It asks, can the business physically produce as much today as it could yesterday? Seeing these two head-to-head is kind of wild. Financial capital focuses on the money, right? But physical capital focuses on the output. These two radically different baselines set the stage for the whole shebang. And why does this matter to you? Well, because depending on which definition a company uses, they might look incredibly profitable to Wall Street, or they might realize they're actually shrinking in their real-world capabilities.
Section 3, Recognizing True Profit. When have we won? We're transitioning now to the exact trigger point, the precise moment each of these distinct philosophies allows a business owner to finally pop the champagne. The crucial difference is how they view the finish line. The financial model celebrates when the pile of net monetary assets grows. You started with $1 million in net assets, now you've got $1.5 million. Boom, profit! But the physical model demands a literal, tangible increase in productive capability. If your net monetary assets grew, but you still only have the capacity to manufacture exactly 100 widgets a day, the physical model says you haven't made a true profit yet. Period. No matter what your bank account says.
Section 4, Rules of Measurement, Valuing the Assets. So we know how they define capital, and we know when they celebrate profit, but how strictly do they actually measure the assets that make up that capital? Take a look at the stark contrast here in their measurement rules. Financial asset measurement uses various bases. It's quite flexible, very adaptable. Meanwhile, physical asset measurement strictly relies on current cost valuation. Actually, scratch that. It's not just strict, it's demanding. It needs to know exactly what it would cost to replace that operating capacity right this very second. Let's see how this builds out on the financial side. Because it's measuring money, the financial capital model gives accountants a whole toolbox of different lenses. It permits several valuation options: historical cost, which is just what you originally paid, current cost, or fair value. It's highly adaptable depending on the specific accounting framework you choose to employ.
Section 5, The Inflation Test, the ultimate chaos.
Here is where the rubber really meets the road. Introducing the real-world chaos of inflation is the absolute ultimate test for any accounting system. Look at how they handle this chaos. The financial model has a critical blind spot. It totally fails to adjust for specific asset price changes. If the cost of replacing your factory equipment literally doubles due to inflation, the financial model doesn't automatically correct for that specific jump when calculating profit. The physical model, on the other hand, it's literally built for this. It explicitly adjusts for specific asset price changes because its sole focus is maintaining that physical capability in the real world. And this leads us to a highly controversial realization: holding gains. Are they profit? Under financial capital maintenance, holding gains, which is really just the increase in the price of assets you're holding on to, they become profit. Your warehouse doubled in value? Great, profit. But under physical capital maintenance, holding gains are absolutely not profit. Why? Because you still only have one warehouse. Your productive capacity hasn't changed one bit.
And this brilliantly illustrates everything we've just discussed. Here is the complete matrix. Putting all the key differences at a glance, you can see how the definitions kind of cascade down like dominoes. Because physical capital defines itself by operating capacity, it requires current cost valuation, which forces it to adjust for specific asset price changes, meaning holding gains are not profit. It is a perfectly logical, interlocking philosophical system standing right next to the entirely different, money-focused financial system.
What you should take away from this explainer is that profit isn't just some cold number at the bottom of a spreadsheet. It's a perspective. It depends entirely on what you value most, the money you put in or the capability you built. So I want to leave you with this final provocative thought to ponder. If your assets go up in price, but your output stays exactly the same, did you really make a profit? Thanks so much for joining me, and keep questioning the numbers.